Welcome to Wealthy and Wise. So why do we as investors get caught up in stories? From bubbles to crashes, the market can convince us that this time really is different. Well, this week on Wealthy and Wise, we look at why stories are so powerful, how they distort our judgment, and what value investors can do about it. Plus, we'll answer a viewer question. Are stories powerful because they make investing feel simple? Why are we so easily seduced by them? And how can we separate a compelling story from the underlying value of a business? Andrew Coleman from Teaminvest is here to help answer those questions. All good questions. Why, Andrew, are investors so easily seduced by a good story?
I think it comes down to two fundamental things, the one out of anthropology and the other one actually out of psychology. So from an anthropological perspective, it's been hypothesized and quite broadly accepted that what separates humanity, us as humans, from animals is not the use of an opposable thumb or anything in specific relation to our brain, but it's our ability to have shared stories and shared myths. For example, just the concept of money, the idea that another item can stand in a barter of an exchange for the proxy, dollars instead of the food that I want. That's a shared myth and a shared story. And our capacity as humans to believe in and internalize and treat as fact shared stories has been our ability to grow nations, our ability to do scientific research, our ability to have economies. But it also makes us incredibly susceptible to all sorts of other stories, whether that is braggadocious leaders, whether it is opportunities to make money or lose money, or, just the way in which we approach any change in technology. So that's the anthropological answer. From a psychological perspective as well, there's a huge amount of research into the concept of social proof. And really what that boils down to, and many of the viewers will probably know this already, is that when as humans we are uncertain, anytime there's change, whether that's uncertainty in our own life or uncertainty in the world, we have a distinct tendency to look to what others are doing to inform us around what behavior we should take. Now, that has wonderful benefits for society in general. It means that if, for example, someone is committing a crime, we look around, see everyone else look aghast, and we will step in to help. But it also means that we can get very caught up in fear and greed, because if everyone else is fearful, we immediately become fearful too, without even thinking about whether there's an underlying basis for that. And similarly, when everyone is greedy, we have a great tendency as humans, if we're not careful, to get caught up in that greed without similarly stopping and thinking it through.
A little bit sheep-like. So I guess another question is, when does a compelling story start to outrun fundamentals? Like, what do we need to be on the lookout for?
I think it's a really interesting point there, because I think there's two elements to that. There's a question of, is the story fact-based? In other words, is there substance to the story, or does the emperor have no clothes? And I think those are very well publicized when they occur, but they're infrequent. Very rarely does, I'm talking from a market perspective here, do intelligent people in the market get caught up in something that's completely Ponzi scheme-like. The more dangerous one is when there is a kernel of fact to the story, and as you put it, the sentiment runs away from the fundamentals. And, we can use some historical examples from there, but those are really usually times where there's great uncertainty, when there's some technology that may change the world for the better or the worse, depending which way you want to look at it. And rather than sitting down and reacting rationally, considered, researched, and rigorous, as we on this show would always encourage people to do, we instead, as humans, shoot from the hip and extrapolate out what we think that story will mean, well beyond where we would get to if we were not caught up in the emotion, living in the moment.
So how do you distinguish then a genuine long-term opportunity from a speculative bubble? I mean, is it sort of as simple as once you get in the back of a taxi cab and the driver is talking about it, that's time to run away? Or is there, something more concrete, something more financially metric, I'm thinking?
Well, there's the two. I mean, the old cab story is a great one, but I think in general, anytime you find that people are talking about whether it's a stock, an industry, an economic event, piece of technology, piece of politics, and the language is emotive, it's a good indicator that the story is getting away from the facts. As soon as we start using language that carries huge amounts of adjectives and emotions, this is spectacular, it's majestic, it's awful, it's pathetic. Any of those kind of languages coming through says we are starting to let the emotion run ahead of what the data is saying in general. So that applies, I think, across all forms of it. But from a value investor's point of view, the really easy test is the same test we've been talking about a lot of the time here recently, which is look at how market sentiment is impacting the specific asset you're looking at relative to that same market sentiment over, for example, the previous 10 years. So if a stock, we can look at the PE ratio. So for example, if a company has traded historically on a PE ratio between 15 and 20, pretty much in line with the long-term market average, and suddenly it's trading on 50 or 60 or 100 times earnings, you've got a pretty good factual basis to assume sentiment has outstripped fundamentals, and vice versa. If it was trading at 15 to 20 and it's now trading at 5 to 10 in an extreme case, well, then fear has clearly outstripped fundamentals, because theoretically, from a value investor's point of view, each dollar should be worth the same to you as an investor, no matter where you got it from. In other words, whether you saved the dollar by, eating at home this week rather than going out to a restaurant, or you made $1 on the stock market, it's the same dollar. So you should not apply, theoretically, a different multiple to that dollar based on its source. So the second you find yourself doing that, applying a higher multiple to one thing and a lower multiple to another, it's an indicator that you, at least, if not the market as a whole, has got caught up in the sentiment, positive or negative, rather than the fact.
So a good value investor will ask themselves what when everybody else is buying into the story? Does it still have a moat? Are the earnings still stable? Look, I've been paying attention, Andrew.
Yeah, and are the earnings growing? As a fascinating corollary to all of this, I sometimes joke, and you and I have had these conversations before, that we sometimes at Teaminvest come across as if we're anti-change or pro other things. It's not really that. What we are is we're pro-fact and anti-speculation. So from that point of view, if a company is growing at 10, 15% a year, it's a pretty good bet that they'll grow at 10 or 15% a year going forward. So their share price should grow at 10 or 15%. If that share price then grows at 50% in 1 year, that's wonderful, but it's unsustainable. The underlying earnings, while great, are not keeping track with the share price. On the same side of that kind of equation, when a share drops 50% and the earnings have only dropped, say, 2, you know that at some point that is going to equalize again the other way by the share price rising to catch up with the path of earnings. So, from that point of view, being a value investor, I joke, is like having a pleasure cruise while all of our fellow market analysts must paddle rapidly in and out of the white water trying to stay afloat, because we just get to look at the basic underlying data and say, well, good or bad, and what's a pretty average price? And if it's not meeting those criteria, we don't have to come up with new stories to sell to clients. We don't have to find ways to justify a stronger and stronger or weaker and weaker DCF. We can just choose to say, well, I'll sit back and do nothing and wait for the opportunity.
All right, Andrew, let's take a look at some examples. Let's go head to head. Okay, as we do, we put the theory to the test. We'll look at how stories can shape our view of companies, prices, and future growth, and then ask what happens when the story gets ahead of the fundamentals by using a few key examples. So, Andrew, history doesn't repeat, but it rhymes, you could say, in many cases. So let's cast our mind back to the tech crash of 2001. I mean, maybe you can start by telling us why we would be thinking of this in the current context.
Look, I think everyone can probably draw that connection, but I've chosen it as an example, not actually because of its link to the modern AI question, though there's potentially, as you say, quite a bit rhyming, but just simply because it's the biggest obvious crash that most people watching the show will remember. I mean, I could have picked the railways, I could have picked the aeroplanes, I could have picked the fax machines. We could pick lots of them, but this is one that probably everyone watching has either lived through or heard about. So it's a good example. And if we remember in the lead up to the 2001 tech crash, from about the mid-1990s, there was this new technology starting to be talked about that was hypothesized to change the world. And it was first mobile phones and then the internet. They came together, hence why it was actually at the time called the telecommunications bubble rather than just the simply internet or tech bubble. And of course, what that did is it enabled huge changes to the world that we have benefited in most cases. Sometimes perhaps we would argue we haven't benefited from to this day. So the underlying fact in the story was correct. The rise of broadband communication, broadband spectrum, and the rise of internet, originally dial-up and then later on cable, was going to change the world. No question about it. But of course, what did we do as persuaded individuals looking for social proof? The more that telecommunications companies, both phone companies and internet-based companies, share prices rose on that rising tide of expectation of this would change the world, so too did that rising tide lift all boats. Both those companies who really probably were going to benefit and those companies who had, like the emperor, no clothes on. The challenge then became that as that bubble got bigger and bigger, it became more and more susceptible to sentiment suddenly shifting. And of course, you can't predict what was going to shift the sentiment. As it turns out, it was a couple of planes flying into a very large building in New York that, of course, changed everyone's sentiment globally, suddenly, followed by the uncovering of the big scandal at Enron, who, of course, were one of the big tech darlings at the time. And from a NASDAQ point of view, the NASDAQ collapsed somewhere between 80 and 90%, depending on how you cut the value. The NASDAQ 1000 dropped between 80 and 90% in a period of about 6 months. So the interesting question then becomes, as an investor, is number one, what should you have done in the lead up? And number two, what could you have done in the aftermath? Because remember, we of course get to play on both sides of that equation. You know, unlike a school exam where you could only study and then write it, we at least have the advantage in the real world of writing that exam every day. If our trading or investing is doing the exam, we can keep studying and keep revising and keep updating our exams. And I think, Nadine, you've probably got a table there which shows who were the biggest losers of the tech crash as identified by Fortune, the magazine, in the end of 2001, in December 2001. So this was their predictors now, not of the biggest winners, but of who the biggest losers had been. And I think our viewers will find that particularly amusing.
Yeah, let's bring it up, guys. The biggest losers of the 2001 tech crash. I mean, yeah, you'd have to live through it to remember a lot about Cisco systems, wouldn't you?
Yeah, well, I mean, look at Cisco. It was at the time one of the world's largest companies. It was in the top 5 by market cap, dropped 87% in 6 months. But today, Cisco is still one of the biggest companies in the world. It's recovered. It turns out there was a lot of fact in what they were doing. It's just that the story to value them at $500 billion in 2001 had run far ahead of reality. In the end, Cisco is a huge business, same with Intel and Microsoft. You look at the next two, but they weren't worth that amount of money back 25 years ago. So as it turns out, if you'd invested in Microsoft in 2000, you would have gone through a period of losing more than half of your money on paper. And 25 years later, you'd be up about, what, 4 times, 5 times? The challenge is 5 times your money over 25 years worth it? And I would argue, no, that's a very low compounding growth rate. But it depends on when in that cycle you purchase the company. Because on the other hand, if you'd been able to withstand the market hype and buy Microsoft at the bottom of that trough, well, you haven't made 4 or 5 times your money in 25 years. You've made 30 or 40 times your money. So from that point of view, as a value investor, a considered, researched, rigorous, and I would argue patient investor, it's not that the story necessarily has no substance. It's not quite as extreme as the emperor has no clothes. I mean, that was Enron. That was WorldCom, which was on that list as well. They really did have no clothes. They were broken businesses. They were frauds in the case of Enron. But a lot of those on the list weren't. They were really wonderful companies with wonderful technology that we use today. I mean, Amazon's on that list as well. But the sentiment had just far outstripped reality. And it took you, in many cases, 15 to 20 years to get back square if you had got caught up in the hype. That's the risk you play when you get caught up in sentiment rather than fundamentals.
Yeah, and I understand back in 2001, Forbes published a list of the biggest winners in tech. And yeah, tell us the story, because this one is particularly prescient this week.
Yeah, it's quite funny. So Forbes wrote an article saying who they thought was the biggest individual loser from technology and the biggest individual winner. And, you know, remember, this is 2001, and they published that their biggest winner they'd felt in 2001 from the tech crash was a small firm called Nvidia, which had come into the the Fortune 500 because Enron, having been exposed as a fraud, had been removed. And they were the biggest beneficiaries. They'd come into the Fortune 500 on the back of winning a new contract with Microsoft to develop a graphics card for a gaming console called the Xbox. And of course, that's particularly amusing when you think about where the relationship between Nvidia and Microsoft has gone ever since, because, Nvidia slipped off that Fortune 500 list in between in those 25 years before they've come back to be the largest company in the world. So you get this really interesting sort of cycle in one of the technology, which can be wonderful, but the sentiment can go from high to low, back to high again. Of course, particularly amusing from that as well, and I know you and I were having a chuckle about this before, was that the person, they named an individual that they thought was the biggest loser from the tech crash, a guy by the name of Michael Saylor, who many viewers may know, because at the time he was the CEO of a business called MicroStrategy, which had dropped 99.99% of its value from $3,300 a share down to $4. He happens to also have been in the news a lot for the last 5 years because he's done it again, ridden it all the way up and crashed it all the way down. So history may not repeat, but it rhymes.
Yeah, well, yeah, reinvented himself as a Bitcoin man. All right, let's get to another big story out there in the market. And I don't know, I guess it's a story, but it's definitely one of those market thematics. It's a sort of green transition, this transition to green and clean. What's an example of that?
Yeah, I thought this was a really good example because often when we talk about stories, we get caught up in thinking about bubbles. And remember, that's only half the equation. The other half is the panic around crashes. And so what I thought we'd do is we'd look at the green transition, not through the lens of green stocks, but through the lens of dirty stocks. So if we all remember about 15 years ago, all the way through to probably about 5 years ago, rightly, huge amounts of research has been published to say that we as a society globally need an energy transition off old school fossil fuels and into clean energy. And I think that's 100% fundamentally true. The interesting thing, of course, was how people in the market then reacted to dirty companies. And the example I've picked up here for us to talk about is Whitehaven Coal. Now, for those who don't know, I presume most of our viewers probably do, but Whitehaven Coal is one of the largest thermal and coking coal producers in the world, based here in Australia. And as that sort of joy of green energy, that idea that we were going to transition became more and more of a theme, and we saw lithium stocks and battery stocks and everyone else rise on the ASX, the corollary was that all the money flew away from the dirty companies. And who is more dirty than a coal miner? And as a result, you reached a point that in 2022, FY22, between sort of June 2021 and June 2022, you could buy Whitehaven for less than $1 a share, which worked out as roughly 1 times earnings. In other words, as long as Whitehaven didn't go bust in the next 365 days, you as an investor were guaranteed your money back. Now, of course, no one at the time had been talking about the energy transition occurring in under a year. We were all talking about 5, 10, 20, 30 years. So that, as a value investor, looked like quite a wonderful opportunity. I mean, I'm not a particular fan of coal stocks and mining because of the cyclicality, and we've talked about that. But the market doesn't often give you the opportunity to buy a stable business with a dominant market position at 1 times its earnings. And had you taken advantage of that in the time since, despite Whitehaven shrinking, in other words, the demand for coal slowly reducing over that time, you would have already made twice your money back in dividends alone, and another between 10 and 14 times, depending what you paid in share price growth in under 5 years. So that's a better return than investing in Bitcoin or AI or anyone else in that period, from owning the dirtiest of old world businesses, just simply because that persuasion, that social proof, that market panic had taken hold so far against dirty industry that Mr. Market, in its bipolar nature, was offering you a good business, maybe not a wonderful business. I don't think Whitehaven is in the top 20 I'd want to own, but it's still a good business at such an irrational price. And so we as investors, sometimes I think on shows like this, we spend a lot of our time talking about the bubbles because they're the obvious ones, but it's also the troughs. that panics. You can make a hell of a lot of money in the middle of a panic. And we talked about it last week, and we talked about it in the lead up, which is, was CSL in one of those moments? And it looks like maybe over the last 10 or 12 weeks, it's proven that it was. But here you can go outside of companies like CSL, which may have a question about other things in relation to them, and look at something as boring as mining and find that data playing out again and again and again. Mm-hmm. And I think we forget that. Money's fungible. The money that moves into one category has to come from something. Yeah. So in the same way as paying 100 times earnings from a battery producer, they also have to start paying 1 times earnings for their competitor in coal. And as a value investor, it's very easy to make money watching other people play poker drunk, as long as you keep your head.
Mm-hmm. Yeah, right. Fascinating. So can we put the two together, if we can, and just give us some thoughts on AI? Is this, we cannot, we've said it before, you can't deny that this is a massive change that's happening in the economy. But are people getting too caught up in all aspects of the story?
Yeah, well, if we use those two examples and we say history doesn't repeat, but it rhymes, I think what we can say is in both of those examples, there was a large element of truth in the underlying story. And I think there's a large element of truth in the AI story. Certainly the way in which we as a society is likely to change through the adoption of the use of AI is material. I don't think that is really in question, at least for me. And I'm a big believer in how we can use AI to improve the world, whether it's through medical research, whether it's through academic pursuits, whether it's just through making your own life more efficient. I think the question, though, comes down as an investor is not whether the theme will be right, because you don't own a theme. You own shares of individual businesses. And the question you have to always ask as an investor in those individual businesses is, what am I paying and what am I getting? And so if I am paying 18 times earnings for a company that is growing nicely without AI, that could potentially grow faster with AI, sounds like a good deal. If, on the other hand, I'm being asked to pay 500 times earnings for a company that may benefit if AI goes down the path it's going down and they're the sole winner and all of these ifs and buts along the way, then to me that sounds like, as is always the case, a recipe for more often than not losing your shirt. But again, that's not that the AI theme is wrong. It's that the euphoria and the price at which you have to pay is taking away any chance of that being a good investment. And if you look through history, there's a lovely old saying, nothing cures high prices faster than high prices. So anytime any asset starts to be bid up, whether that's the hourly rate of a tradie or the price of gold or yields on federal bonds or Bitcoin or share prices or anything, you can be certain that once the price is high enough, oil, people will start to look for alternative ways of delivering the solution at a lower price, because that's an opportunity for them, and they will find ways of undercutting it. And I think that that's probably what will play out with AI. I think it'll be interesting. I think in 10 years or 20 years' time, let's stick to the AI example from 2001. In 25 years' time, we'll pull up a list of the 15 biggest companies or biggest winners and losers from AI, and you'll get a similar look of the ones of the internet. In other words, some of them will be right, but it may have lost you a lot of money on the way, and others will have gone to zero. And the challenge would be, how do you pick which one is that today with the information we have? So I would, as a Teaminvest value investor, we invest in things related to AI. Everyone does, but we still like to own the businesses that are profitable and growing without AI, where they can get a benefit from AI rather than trying to leverage into the AI story where there's just too much uncertainty, too much hype, too much likelihood of blowing up your capital.
All right. Good edition of Head to Head. Let's now answer a viewer question because you asked. You too can get a question answered by the team, wealthy@ausbiz.com.au. And I kind of knew this was coming. What do you make of Data3's recent result, Andrew, considering you've talked about this company in the past? In fact, I think just last week. This one's from Bronte. Bronte, thanks for watching. Thanks for writing in. Andrew, earlier this week, we heard from Data3, a Teaminvest company. Correct me if I'm wrong. What did you make of the result?
Yeah, I think we're in the top, in aggregate, our members are in the top 5 shareholders, and we have a large position in the fund. Look, business as usual in the best possible sense of that. So one member wrote to me, and I always enjoy when they write pithy things, quoting them back. They said there's only three certainties in the world: death, taxes, and Data3 raising its profit. I think that may be a little bit of hubris. There will be a time where Data3 cannot raise its profit. That doesn't always happen every year forever. But, we were talking about companies that benefit from AI but are not seen as AI companies. Data3 is a wonderful example. Data3 is a provider of managed software and hardware to large corporates and governments. In other words, the more that governments and corporates want to spend on tech, the more they lean on people like Data3 to make that happen, and the more companies like Data3 clip the ticket. Now, they don't clip the ticket at an increasing percentage. It's the same contractual percentage, but if the contract is bigger, that's simply more dollars. And so as a result, Data3 seems to be able to grow its earnings for between 13 and 17% per annum for well over a decade now, with no sort of sign of slowing down. And they are clearly going to be a beneficiary of this move to more and more AI. Whether the governments and large corporates use that AI well or not, whether the AI they buy is from Microsoft or Anthropic or OpenAI or Grok or whoever, doesn't actually matter. They're still purchasing it for a company like Data3. And given that Data3 seems to be the best run in that space, at least for the foreseeable future, that's a wonderful moat.
Got it. Thank you, Andrew. Thanks for answering that question for Bronte. Hey, it was nice to host this show with you. Andrew Coleman, Teaminvest. Thank you. And thank you for watching Wealthy and Wise. We'll see you next week.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.